Hello, this is Doug Gerlach from iClub Central. Welcome to our Lunchtime Stock Club webinar. Today is Monday, May 4th, 2015. Glad you could join us today. This is not our usual Monday. We typically meet on the second Monday of the month, but I've got a big schedule coming up. I'll tell you about all the activities I have going on in May. So we rearranged it, but I'm glad you could be here. We're going to take a look at the market. We're going to take a look at some stock ideas and answer some questions. And if you have any stock ideas that you'd like to take a look at, please use the questions box to fill me in as we go, and we'll try to do our best to take a look at those in Toolkit 6 and see if they might be suitable for your portfolio. For technical problems with our webinars, please contact GoToWebinar directly via their toll-free number, 800-263-6317, or visit gotowebinar.com. for 24-hour-a-day, 7-day-a-week support available right there on their website with FAQs, and you can chat with a representative and diagnose any problems you might be having. If you can't hear me now, if the sound or graphics are choppy, we always recommend trying these steps, turning off any unnecessary programs on your computer that might be interfering with the streaming of data that's being displayed and coming out of your speakers. Turn off all those programs that are running in the background in your system tray, especially they might be scanning your computer or otherwise taking up your computer processing power. Don't connect using a Wi-Fi device if you can help it. It's always faster if you're hardwired into your internet modem. And you can always listen using the telephone, which will free up your computer to display the graphics properly and also allow you to hear all of the audio in our program today. If you have a question, please use that questions box in the GoToWebinar application. Type it in at any point. I'm monitoring those questions as they come in now. I see some stock ideas coming in that we can take a look at. So please feel free to use that to address your questions, your ideas, your comments, and we'll do our best to get through as many of them as we can in our presentation today. On the iClub.com website, you'll find all of our upcoming webinars listed there, so you can easily schedule those or sign up for the ones that you the series that you haven't missed, or the series that you haven't signed up for, right there in the Learning tab. That's the key thing to remember. There's also a link on our homepage in the Quick Links section, the main page of iClub.com, that will also get you directly to the webinar section. As a reminder, the archived webinars include the links to the PDF handout. So if you ever want to grab that handout, you can just go to the archived webinar without viewing it, but look for the attachments tab there and download that PDF handout. Finally, you can like us on Facebook for occasional updates and other messages. Just search for iClub Central there, like us, and we won't spam you with a lot of information, but we'll post important offers, and we'll post when videos are archived, the webinars are archived, notes about upcoming webinars and schedule changes, etc. As I mentioned, we have a series of webinars that I produce each month, including this Lunchtime Stock Club and our Investment Club webinar, which is not just for treasurers, but for all Investment Club members. We took a look at a full range of Investment Club operations issues, trying to help your club become more successful. And our next club webinar is Tuesday, May 19th. We meet on the third Tuesday of the month at 9 p.m. Eastern Time. And then our Toolkit webinar meets on the first Tuesday of the month, which happens to be tomorrow, Tuesday, May 5th. And we're going to be taking a look at how to conduct a quarterly company review in Toolkit. What do you do when a company reports its earnings and sales for the most recent quarter? What are the things that you need to do in Toolkit? How do you enter the data? How do you review the data? How do you evaluate that information? So that'll be a real key webinar for people who are using Toolkit. You want to get the most out of the updating function, how you track your stocks, and what are the things you might be looking for as your companies report. And then we'll be back on Monday, June 8th, the second Monday of the month, for our Lunchtime Stock Club webinar. So that's our upcoming webinar schedule. I look forward to seeing you join us for all of those companies as we, all of those events as we produce them, as well as some other events in person and online that I'll give you my upcoming schedule at the end of our time today. So the market, since our last meeting in April has certainly had a little bit of ups and downs to it. Here is the graph, the year-to-date market performance that I like to track, that shows the EFA index. That's the Europe, Australasia, Far East index. So this is the developed world, up 10.35% for the year and leading the pack. The red line is the Russell 2000, and you can see that had been doing well and was outperforming the S&P 500, which is the blue line on the bottom. And then last week, the Russell took a tumble on Thursday and lost a bunch of the gains that it had made. And now it's just running neck and neck with the S&P 500. Of course, it's always hard to know what's driving these sort of near-term gyrations of the market. There are concerns that the biotech industry in general had kind of topped out, was in bubble territory, so a lot of those stocks took a hit. Those were typically smaller and mid-sized companies, so that has a big impact on the entire sector, and then investors and traders get a little nervous. Another factor is that energy prices rebound, and in fact, the sector in April 2015 with the best performance was the energy sector, and this is, I guess, reversing a trend of the last several months. Energy stocks have not been performing well, and now all of a sudden, energy stocks are recovering, while biotechs are falling. So, and healthcare was one of the worst performing sectors of April. Again, reversing a trend we've been seeing in the last few months, where healthcare stocks have been doing well, and now they have had their own little mini correction, perhaps. Energy stocks have their best month since September of 2013 in April. And a lot of those energy stocks are larger stocks, and so that's partly the reason for some of the adjustment that you've seen there. Interesting to see where we're going to go from here. If you look at the S&P 500 PE ratio over time, the PE as of today is about 20.67, so just over 20. It's been over 20 for the last couple of months. In April, when we met, the PE ratio was at about 20.5, so it's up a little bit since then. It's been climbing, as you can see on the graph there. I added the red dotted trend line to kind of see where the PE ratio has peaked in the last 100-plus years, since about 1870, I think, or 1860. This graph goes back to. So you can see the trends there. Obviously, bubble territory in 2000, and then again in 2008. But now, where do we stand? Well, the PE ratios have generally been a little bit higher since the 70s or the 60s even, as the cycles of the economy have shifted. And as the consumer economy has shifted, our country's economy has shifted in the last half century from industrials to now consumer goods and services. About 70% of our GDP now comes from consumer spending and consumer goods as opposed to industrial manufacturing. And that's a big change from where the economy was before. So when you look at a trend like this, you have to bear in mind what were the factors that were affecting the market and the business cycles and the businesses in those industries and sectors in the course of time. So it's interesting. I think the another theory about what happened last week in the market is that the summer is coming. The weather has finally turned here in the Northeast. We're finally getting some warmer days, and winter is becoming something of a memory. We're still subject to freeze warnings, so you can't start your gardening for another couple of weeks. But on the other hand, we've had some beautiful weather, and that's certainly, I think, impacting the thinking of a lot of traders and investors. It's not at all uncommon over the summer to see a little bit of doldrums as the traders and a lot of investors are taking vacation. They want to unwind positions and not have to worry so much about their portfolios while they're lounging on their yachts or out at the Hamptons at their summer homes over the summer months. So you see, maybe this is the first sort of sense of, let's just get out of these high flyers a little bit so that we don't have to be so stressed or feel so stressed. We can enjoy the summertime. We can enjoy time with our families and travel. So there's a sense of maybe that's happening, that the weather is impacting, and certainly the weather turning and summer coming upon us. So that's another possibility, what's driving the market right now. If we look, let's take a look at our usual maxim about buying companies, not buying the market, focusing on valuation. Certainly, we hear a lot of talk about the bull market extension and how long it's been going on, and we look at the P ratios that have been rising steadily for the last couple of months. When you look at the S&P 500, the rising tide that lifts all share prices, so you see a lot of companies performing well and selling for pretty high valuations. So how do you make sense of all that, and how do you manage that in your portfolio? We always talk about buying good companies at good prices. I'll be doing a webinar later this week for the Retail Investor Conferences series that PR Newswire and Better Vesting put together about selling overvalued stocks. When's the right time? What's the proper things to be looking at when you've got stocks that you're holding at high relative valuations? How do you unload them successfully? When's the right time? And that's something that I think is on everyone's mind, and there's no avoiding it. But related to that, here's some words of wisdom from George Soros, the legendary investor, on stock market bubbles. George once said, stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality is distorted by a misconception. And this is, and of course the question is, what is the misconception? What are investors looking at that gets them so confused? And I think it comes down to greed. It's misguided greed that comes into play and drives those prices up, a sense of invincibility as your past decisions have proven successful because the market is reinforcing your moves by driving the share prices up, and that often creates a sense of infallibility. And investors tend to become a little complacent and a little sloppy in their analysis, in that general feeding frenzy will push the market up. When you start out with a stock market bubble has to start somewhere. It doesn't start with imaginary factors. It starts with good corporate earnings, good company performance, good economic fundamentals. All of those factors have to be in place to drive the market upward, at least at the start. The problem is that the market tends to get ahead of the fundamentals, and so that's what happens in a bubble. The market is ahead of the valuation, and then at some point everything snaps, just like a bubble, a soap bubble that pops. Everything comes to a head, and the market collects itself. Investors start to look at things more rationally, but again, then they get driven by fear more than rationality, and will push down the price of things as they try to flee from their previous bad mistakes. So how do you fight against the misconceptions and the distortions that our psychological approach to money often engenders? And the answer to me is having a consistent approach to the market and fundamental tools that are not based in emotion and intuition, but are based in an understanding of what drives prices over the long term. Having an understanding that the near-term gyrations of the market are not at all significant to your long-term performance, in as much as they provide opportunities for you to buy, but they're not dictating your overall performance. We don't measure things in the short term. We don't look at our 3-month, 6-month performance. We break it up here. I break up my the year-to-date performance of the stock market as just as a quick way of judging where we stand since the start of the year. It's a useful measure, but it doesn't tell me how well I'm doing as an investor, and it doesn't tell me where the market is going from here. So we're going to continue to watch it. Certainly the bull market is continuing to expand. The economic cycle is going on in an expansion mode since around March 2009. So it's a pretty long period of time for bull markets, for economic expansions historically without a correction or a recession in place. But hopefully, again, things have been managed well. Companies have become a little more prudent, a little more careful in their deployment of resources to not get overextended, so they don't see a repeat of the factors that created the housing bubble in 2008. At least that's my hope and understanding. But as we know, Wall Street is a very short street in New York City and tends to have a pretty short memory as well, as people forget the lessons that they learned pretty quickly. So we want to avoid the misperception. We want to avoid the distortions that come from those, and see what we can do to become better investors using the principles that we have. So let's take a look at a stock of interest today. And today we're going to take a look at a pick from our Investor Advisory Service newsletter from the most recent issue, the May 2015 issue, which came out a couple of weeks ago. And interestingly, Rita asked about this same stock. It's Polaris Industries. The ticker is PII. It's a maker of recreational vehicles, known for its snowmobiles, certainly, but also off-road vehicles, ORV, and increasingly for motorcycles. They've purchased the Victory Motorcycle Company and the iconic Indian motorcycle business, and they also are producing a new series called the Slingshot, which are three-wheeled motorcycles, and those are becoming phenomenally more popular. They're considered safer for mature riders, so older riders often like those three-wheelers. They can get around and feel a little more comfortable sticking to the road, but still get all the pleasure that comes from riding a motorcycle. So that's another part of their business. It's a mid-sized company. 2014 revenues of $4.5 billion. 85% of the sales are in the U.S. The rest are mostly in Europe, but they are expanding in Europe. They've got a manufacturing facility in Poland that they're building, and they're also expanding in India. They're building a facility there, and they're developing a personal utility vehicle that could be one of the highest selling products in their line by volume. If you've ever been to India or seen movies or films of the small vehicles that they have, this personal utility vehicle is, again, very small, can navigate the narrow streets, narrow busy streets, and allow businesses to use them for business purposes. So that could be a big market for them. Now we know that this is in the consumer cyclical sector, so it's going to be sensitive to the economic pressures. In 2008, sales dropped about 20% for this company. If we look at it in Toolkit 6, here's the company profile for the last 10 years. We've eliminated 2005 on this graph, but you can see the downturn in 2008, 2009 as sales dropped, and earnings also fell. But otherwise, pretty consistent. What's interesting is even though the earnings flattened out, declined a little bit, they didn't go into negative territory like some other businesses. Car makers during the recession typically stopped making money altogether. But this Polaris didn't quite do that. They certainly saw the recession. They certainly felt it, but they climbed back out of it pretty quickly. And that's kind of a positive note for this kind of company. But something you definitely want to keep in mind as you're evaluating consumer cyclical stocks and how they behave in the market. You can see since the IAS reported on the company in late April, they did report their first quarter earnings, so you see a little decline there. And that's a raw value, hasn't been analyzed yet to see what the what the cause of that little bit of drop-off in the trailing 12-month earnings is, or if there are any adjustments they made, but certainly not a little bit of a little bit of a concern. The price only fell about, let's see, it was $141 a share at the time of our analysis in the IS, and today it's something like $139. So it looks like the market was looking and expecting that decline. The stock did not react terribly dramatically. So something to look at, something to understand, certainly the most recent quarterly performance, and I'll leave that to you. Things that we like about the company, the pre-tax profit margin trend is very positive and moving in the right direction. You see a little bit of compression as it came into 2008, but then steadily improving and improving beyond the pre-recession figures to above 14%. So that's pretty significant growth to see from below 10% to over 14%, closer to 15%, over 15% then to land last year at 15.6%. So operational efficiencies are really coming into play and helping this company to become more successful. And you can see that here in the pre-tax profit trend. And that's a trend that, if it continues, will help deliver better, stronger results, will help continue to allow the company to perform well during recessions. But again, we can't always be sure of how a recession is going to, how long it's going to last, and what the total impact of it is. If you flip back here, since 2006, the average sales growth rate is about 13.8%, and the average earnings growth rate is 23.5%. The IS seems to think that the analysts there are looking at a 16% long-term earnings per share growth rate. In the last 5 years, it's grown at about 34%, so they're dropping that down a little bit. And the PE at the time of the stock study was 21.3, so it was a pretty reasonable growth to PE ratio analysis there. If I flip back over to my toolkit, we can take a look at some of the other factors on page 2. The current PE ratio stands at about 25 because of the drop-off of earnings, but here are some of the values in my study that differs a little bit from, oh no, actually the high price of $310 in 5 years, that's what the IS, what we showed in the IS with a downside price of $100.40. So at today's price, it's a little more attractive than it was a couple of weeks ago. The upside downside ratio 4.4 to 1 when we published the PIC. The compound annual return was 18.4%. Now it's 18.8%. Yeah, there's still some room there for compression of the growth rate. If you chose a more conservative growth rate, it might stand in. Now, if you will note, the relative value, the average PE ratio of the stock is 25.6. That's shown right here. I'm sorry, the average is 18.7, and the current is 25.6. So like with many companies in the current market, that's a little bit pricey. We like to buy on a decline if we can, but otherwise we're always looking for the best opportunities in the current market. Last month, you may recommend or recall that we looked at United Insurance Holdings, and that was selling at about $20 or $21, and now it's down to $17. It took a big hit last week as a small cap stock. Really, it took a little bit of a beating. But that, to me, just means that the long-term prospects are probably a little better at the current price. Might allow you to get a better rate of return. I actually think the company is more attractive at that lower price. So if you didn't look at that company last week or last month, or if you looked at it and set it aside, you might want to revisit it. That's United Insurance Holdings, UIHC. Frederick asks, and this is an interesting question, why do I delete the PE, the low PE ratios? Well, when you're looking in section 3, we're looking at the history, and it's called the price and PE ratio history on the stock selection guide. But we're also looking ahead to the future. So we can see how the company was valued in the past when it was growing at 30 growing earnings at, say, 30 to 34% on an annualized basis. That's where the market was valuing the business. You can also look at the trend of the PE ratios. Click on the pink graph, you can see the trend. In this case, you can see that the PE ratios have been trending up since the trough of the last recession. PE ratios kind of been trending up. But when I look at these, I think that many of these values are not suitable for a stock that might be seeing its growth rate decline, or certainly if the growth rate that we're using in the stock study is lower. If you are projecting lower growth than historically the company has experienced, then it also makes sense to reduce your PE ratios, your high and low PE ratios. So coming through and looking at these values and making some adjustments based on, playing the game, one of these numbers is not like the other. So in this case, you see PE ratios of 19, 20, 20, 27, 24. Well, the 27 is pretty high compared to 19 to 20. The couple of values there at the beginning. 24 is a little higher, but it's not completely out of range. And we play the same thing on the other side. We know that typically stocks that are growing at the growth rate that Polaris has been seeing are not going to bottom out at 17 or 18. And it would take a lot for them to get down to 9 or 10. So that 12 to 15 range on the low side is probably kind of about the average that I would say that a company would sell for. There's so much going on in PE ratio analysis, and I've done webinars on this topic in the past. But there are factors to play such as investors. When they look at a company like Polaris, or especially larger companies, if the P ratio starts to get too low, they're not gonna let it drop, continue to drop. Value investors are gonna pounce on that company and support it. There's a floor at which the stock price is going to be picked up and driven back up again, because other types of investors that might not be growth investors might be looking at those and saying, gosh, this is a real opportunity here. So there's that at play. There's the relationship of what the high PE ratio is to the growth rate. I have a rule of thumb that says your selected high PE ratio should be no more than 150% of the growth rate. So with a growth rate of 16%, 150% of that is, 24, a PE of 24. So I wouldn't use a PE higher than 24. In this case, you can look at the results and say, well, that rule of thumb doesn't come into play. It's only been a couple of years, the last 2 years, during a bull market, that the PE ratio has been 24 or higher. So you know what I'm going to do? I'm going to reduce my selected high PE ratio, and our analysts did the same. Using something like 22, I think makes it a little more relevant to what we're looking at going forward. So there's so much going on there, but when I'm looking at section 3 at the high and low PE ratios there, I'm clicking to not only because I think that they've been unusual in the past. No, they've actually happened in the past. So, but it might be that 1 year it was 32 or something. That would be clearly out of range. But I'm also kind of looking at the values that are more conservative. So I'm removing the higher PE ratios, the higher low PE ratios, and in this case, 9 and 10. That would take an awful lot of bad news for the company to get down there. And our stock study is not based on a whole lot of bad news. It's based on a kind of normal performance. So we're going to try to capture that. So I just feel like 9 or 10 is too small. So hopefully that makes sense. As I said, there's a lot going into PE ratio analysis, a lot of understanding of where the market is, what the factors that are driving the company's historical or signature PE ratio, and then our expectations for future growth of the company and how they'll fit into a particular valuation range. So that's where we end up with those prices and those high prices and the low prices and all of the other ranges that come together there. Okay, let's, Frederick asks about EMC. This is a stock that had been tracked by Investor Advisory Service in the past. This is the big in the past, but it's no longer. This is a large technology company. Let me update the data here in this stock study, and we'll take a look. And you can see this stock was, we recommended, I don't recall quite when we stopped covering EMC, but let me just confirm, look it up here real quick. Yep, so I'd have to look it up and see exactly when, but it's sometime in the not too distant future, and I think part of it is you can see the earnings were actually flat last year. The most recent quarter ended March 31st. You can see this down here. That continued that downtrend of pre-tax profits and sales. So I think there's a feeling that it's, the longer-term growth rate is not at the minimum that would be required there. It looks like maybe the last time we were tracking it was something like 9%. But the recent trend, if you look at the historical growth trend, for the last 3 years, earnings have grown at 6.3%, 3.1%, and 1.5%. So this is this growth rate that shows us growth over here for the last 9 years, and then we continue to drop off years, so we see the growth for the last 1 year. And what it's showing is a slowing of the growth rate for EMC. It just means that every year it is getting bigger, but it's getting bigger at a slower rate. And what happened actually last year is that rate actually went into negative territory, and the company actually earned less money than it had the year before, so the earnings growth rate became negative. And again, anytime the growth rate of earnings is falling below 7%, it's very hard to justify holding that company if you want to achieve market-beating returns. Why? Because our approach is based on capital appreciation of the stock primarily. So we're looking at companies that we want to see earnings and sales growth that's going to drive the stock price over time. The last couple of years, you can see the very narrow ranges of high and low prices. The stock has just not done anything really very exciting since 2010. It's just been flatline there. And the concern is companies so big, I think, that investors are wondering what's going on. You look at the pre-tax profit margin trend. This is not the worst in the world. It's a little bit of a downturn, but you could argue that 12 and 13 were kind of peaks in the relative past, and maybe this is a fairly normal range. But that's something to consider there. So. It's hard to make the case. They just started paying a dividend in 2013. In many cases, when companies start paying dividends, it's an acknowledgement that they're making a whole lot of money, they have a whole lot of cash, and there's nothing that they can reinvest within the business that's going to help them, that's going to really help them to grow that business from this point going forward. So I think that's part of it that will definitely give you a little bit of a yield. The current yield is about 1.7%. So again, if you expect 6 to 7% earnings growth going forward, and that will drive prices 6 to 7% plus a 2% annual yield. Plus, if you buy it when the P ratio is cheap, it's still really hard to get to a rate of return that's going to satisfy you in your portfolio. It's just a very large company. So again, not that it's a terrible company, but it's just it's gotten so big that it's really hard for the company to be nimble and really hard for it to find new sources of revenue growth that will drive profits. I did at a workshop on Saturday in Cleveland, Ohio, where we looked at the stock selection guide and walked through it. And to illustrate this concept of a company that's growing but just not driving the business at a rate that's going to make investors happy is Walmart. The Walmart's growth rate has been declining so significantly in the last 5+ years. It's just growing more and more slowly. and if it needed, it's a $485 billion company by sales. So if it wants to continue growing at 10%, next year we have to find an additional $48 billion of sales from all of its business lines. And it's just very difficult for any business to do that. And where in the U.S. can they expand? They are focusing on other factors like operational efficiency, smaller stores, their smaller grocery stores, the neighborhood market chain that they're launching. Again, those are lower volume, lower price, lower margin businesses. So that will contribute to the bottom line, but it's not going to be a big win in terms of the profitability and revenue growth that is needed to drive big earnings gains and big share price gains over the long term. So that's my take on EMC. I don't follow it specifically. I'm certainly aware of the business and what they're doing with data storage, and hardware. But those are just some thoughts based on what I'm seeing right here. Okay, next question. Kevin asks about my thoughts on Corning, GLW. Actually met some people on Saturday while I was in Cleveland who worked for Corning and from the New York State region. And so let me just do a quick analysis here. Very big business these days. Interesting when you look at the Corning, we think of Corning and Corning Glass traditionally, and certainly their ticker symbol, GLW. But we think of Corning and Corningware, the kitchen, but now it's interesting, they're considered a technology company, and they focus on electronic components and certainly making glass for smartphones and other devices that's strong and tempered. It's a big driver of their business. $9.7 billion in sales, so we would consider that a large company. Most recent quarter, sales were flat. We want to understand that. Earnings up 25% though, and you can see that in the pink pre-tax profit margin line that's kind of going up with earnings. Going a little faster than earnings in the last year means they're driving some operational efficiencies there. That margin is increasing a little bit. A little choppy in terms of sales and earnings growth, and I think my investment club actually owned Corning for some time, but we're just not very happy with this 2009, 10, 11, 12 performance, although have recovered in the last couple, in 2013, 2014. But you see the earnings are actually, have been much higher, 1, 2, 3, at least 3 of the last 10 years. So earnings have actually been trending down since 2008, although they're moving up. And again, we might want to look at these numbers a little more carefully and see if there's anything going on. So the question is, what would be a reasonable growth expectation for the business? Let's say 7% sales growth. Earnings might be a little higher because of the operational efficiencies, so I might say 9%. Looks like the analysts at Morningstar polls are at 10%. So again, we can go out and find more results. So let's just do a quick back-of-the-envelope analysis here and assume 9% growth, which would be within our minimums for a company of Corning size. On the backside, the margins, not the prettiest trend in the world, but definitely moving up. And again, there's something going on in 2009, 10, 11 with the business. Maybe they've restructured and removed some businesses because those margins are just very high, seem to be exceptionally high. And maybe there's a new normal that's coming in here that we might want to take a look at and kind of understand better. So that's my quick interpretation of this is that, yeah, it's moving up over time. In the last 5 years, it's been a little choppier, but maybe these if you took out 8, 9, and 10, this would be a more straightforward kind of graph. So maybe those years are outliers. I don't know. I'd want to understand more about that. In terms of the PE ratios, these are what you'd expect from a company growing at sub 10% a year rates. On the low PE ratios tend to be a little higher. The high PE ratios, I would take out the 9.4 just for the sake of argument and use those Section 3 averages, 13 and 8, pretty tight range. But again, there doesn't seem to be a whole lot of question about their their viability as a business. Yields between 2 and sometimes over 3%, so that's an attractive part of the analysis for some investors. Current P ratio at 11 is well within the range of what we consider kind of normal, a little bit above the average PE ratio, so that wouldn't be the worst thing in the world. And then in terms of the low prices, Toolkit pulled in, made it 16, just pretty close to 15.3, which is the product of the low PE of 8 times $1.86, which is the trailing 12 months earnings. So at that point, it looks like it's a reasonable buy at the current price, but the total return is not going to get you to 15. There's not much of additional possible upside there. It might be that if you looked at these, the payout might increase the average yield a little bit. So, right, because the payout was 8.9 and 12.7% 3, 4, and 5 years ago, but recently they've been paying out a much higher percentage. They've raised the dividend, and they're paying out much more in earnings and keeping that yield up. So that gives you an average yield of 2%, which added to the price appreciation gets you 14%. So not the worst company in the world, but my feeling is it still feels like kind of an old school technology stock. It's transforming its business, and you want to pay attention to that and compare it against other opportunities for companies of a similar size that might get you more growth and appreciation over the long term. The price volatility, yeah, you look at the share price. I mean, I think that's a factor for a lot of investors looking at the share price and saying, gosh, if you bought at the wrong time, a decade, 4 years ago, 7, 8, 9 years ago, you'd still be holding it at a loss in the minus column. If you bought smart, at any of these peaks or the bottoms of the price ranges, it might still be a reasonable return candidate at this point. So again, want to understand more about the business and what's the potential driving it in the future. I worry about the market adoption rate of its product line, and we know that smartphones and devices are increasing, but there's also a lot of price pressure, and the prices of those devices are coming down. So sort of a premium glass may not be something that investors or that customers are willing to pay for. And so I want to understand that a little bit better, and that's certainly questions that I would raise against it. Walter asks, do you believe the rule of large numbers is against Apple advancing further? And certainly Apple took a hit last week, and Apple certainly, much like Walmart, is just a very big company at this point, $182 billion in sales last year. Recent quarter still driving up after the flatlining of 2013. Sales still marginally up in 2014, but have dropped down quite a bit. Toolkit's judgment, looking at recent growth and weighting that more heavily, plotted things at 7%. I think that's about right for Apple. Analysts, the Morningstar polls have it at 11.5% earnings growth over the next 5 years. I think that's a little optimistic, perhaps, but again, yeah, the rule of large numbers would just make it, to see growth of 10%, they have to sell an additional $18 billion worth of devices and operating systems and applications and other revenue in 2015. And I just feel like that's kind of aggressive, and I certainly wouldn't use that in my analysis. We follow Apple in the Investor Advisory Service, and let me just look it up here. Our analysts are expecting 7% growth. So there you go. That's the basis on which they're looking at that. And I'm looking at the April issue of the newsletter that I grabbed right here in front of me. At that 7% growth rate at a price of $128, which is exactly where it is today. so this was as of March, the total return is about 7.8%. Again, so 8.5%. I think the most recent quarters come in, and again, some of these PE ratios you might want to knock down a little bit. Let me real quick run through what I would take out the higher high and low PE ratios. I would yeah, I feel like that's a good floor. That $77 on the low side might be a little low, but it has gotten down to below 10 in the last 5 years. So a PE ratio around 10 is probably appropriate. It would not take much for Apple to miss, for the Apple Watch to disappoint, even though they're pretty low expectations. So that puts it into a hold zone right now, with an annual return of 8.5%, buying up to $103. Our analysts had it buying up to $85, but again, that was 1 quarter ago. So $103 is what I'm seeing in this analysis, that I think is probably pretty reasonable at this point. But yeah, I think the key is if you're projecting more than 7% growth for Apple, you need to have really good reason for doing it. And again, these long-term trend lines, this red trend line for earnings and share growth is advancing at 50% a year over the last decade. So 7% is much more slowly. If you look at the historical growth chart in Toolkit, you can see the reason that the growth rate has just been slowing enormously. Nothing wrong with that. It's just, it just needs to be factored into your analysis. There's just only so far and only so many products that Apple can produce that are going to deliver the kinds of performance that you saw when they were making the iPhone and the iPad and the iPod, the devices that have made them so well known today and are driving growth of their computer platform, which still is just a minority of personal computer usage. But that's what we're looking at right now. All right, we're going to take a look at one more quick company. Pascal asked about NCR, so let me pull up NCR. And let me update this stock study with the current data. Here we are as of, this is the stock, the NCR is another stock that the Investor Advisory Service had been following and stopped following. And again, why? Because it's a kind of a troublesome trend on the one hand. You can see that the analysts, when they produced this stock study back in 2013, removed many of the years. You can see also, it looks like to me like that 2013 year was out of trend, so you still see a little bit of growth going forward, 14% annualized since 2010 once you take out that 2013. But again, you see another downtrend. Most recent quarter down 25% in earnings and sales down 2.8%. You can explain away the earnings per share drop, but the sales drop, to lose 3% of your sales quarter over quarter, is pretty serious, and that's probably one of the problems. So not a pretty graph, not a pretty history, and that does not bode well for our analysis. Kind of all over the place in so many of these different metrics. Even if we take out this 2013 and look at the trend, that's a little bit better. But kind of coming out of the last recession, they've been rebuilding their business at a slower rate. I think the business has been changing there. And so when we look at the past, we're seeing less of a guidance as to what the possible future might be. So in this analysis, again, it's a lot of high PE ratios, which I would consider out of range. Even the 35 last year I would consider out of range. The 18.6 and 11.4, what our analysts were using. And if you apply those today, it looks like a low price of $22, high price of $37, current price of $28. Just not much to get excited about from this company. It certainly doesn't fit anymore our quality guidelines for looking for consistently growing businesses. It really seems to be, if I restore all of these, it just looks like a terrible story. Lots of terrible performance during the recession, where earnings fell off. Even if we take that out, you see a general downtrend that only recently has started to restore. So that, to me, just by looking at the numbers, doesn't tell a very pretty story, and you might want to think of other businesses there that might give you a little bit better performance. All right, so where am I going to be? This May 7th, I'd recommend that you keep an eye out for the retailinvestorconferences.com virtual investor show that's going to be on Thursday. I am on at 10:45 a.m. in the morning, and you can register for it, sign up for it, and even if you don't attend, you'll be able to view the archives. And as I said, I'm dealing with offensive portfolio management, how to determine when to sell the winners from your portfolio and how to protect your gains. So we'll look at some strategies that can help you maximize, and if you're sitting on some stocks that have been performing well as the bull market has extended and you're thinking, well, what do I do? Hopefully we'll give you some advice there. And then next week I'll be at the Money Show in Las Vegas, followed by immediately the Better Investing National Conference in San Jose. So looking forward to seeing many of our users there. They'll be back on the East Coast in June for the InvestEd Conference in Richmond, Virginia, June 11th to 14th. Richmond is easy driving distance for many people on the East Coast, so you might want to definitely check out that event at the InvestEd website. In September, I'll be in Central Pennsylvania for their Better Investing Chapters Education Day, and then also the next weekend up to Chicago for the Better Investing Conference, as well as our regularly scheduled series of webinars. So I want to thank you again for coming to our Lunchtime Stock Club. I hope that you're managing your portfolio wisely and making the best investment decisions you can. And as always, I hope that our Club Central tools and newsletters can help you with your decision-making, analysis, research, and portfolio management tasks. Wish you all the best. We'll see you next month.